All right, here we go. Welcome to Stock Options Futures. Ooh, this is the disclaimer. This information, this is educational purposes only. This information is designed to help you learn more about futures trading. If you have any advanced or intricate questionings, make sure you consult financial advisor, your broker. They can give you absolute information. All right. So futures trading, it allows you to trade index assets and commodities. All right, so futures trading is a 23-hour, 6 days a week trade. The structure of futures trading we will get into on the next few slides. This slide is absolutely important. We only want to apply for a cash-only futures trading account. We do not want to trade on margin. Margin is pretty much trading on the loan. We don't want to do that. So what are futures? So futures are index assets. The index is your S&P 500. The index is your Nasdaq 100. The index is your Dow Jones. The index is your Russell 200. These are your indexes. These are the market. All of your stocks, Googles, Amazon, Metas, Apples, all of them, Visas, any stock company that is publicly trading on the market is positioned in one of the indexes. Okay. The outer country stocks like Baidu, like Alibaba, other countries have indexes as well. Okay. So America's indexes is the S&P 500, Dow Jones Industrial, Nasdaq 100, Russell 200, right? And futures allows us to be able to trade those assets, those indexes, along with commodities such as wheat, rice, gold, silver, oil, corn, any agriculture. You can trade on futures. All right. It's similar to options. Futures, you have a contract and an agreement and the expiration date. You purchase that contract for that asset or commodity to go up or down. All right. So that's the overall for futures contracts. Futures contracts, will get into the cost and how you get paid from them in the next slides. All right. So these futures trading has exchanges. Okay. And these exchanges is what hosts the indexes and those commodities for us to be able to buy and sell. So they're like the third party, right? The middleman. Right? They determine the price, they determine the value of the contract, and then they determine executing your trade or transactions. Okay. Now, most popular is the CME, Chicago Mercantile Exchange, and there's the Eurex, right? There's the ICE, there's the SGX, there's the LME. Now, each of these exchanges host different assets and commodities. That's where you'll purchase your contract through the exchange that hosts the asset or commodity that you're looking to trade. Each brokerage provides these exchanges real-time data. Some give it to you for free based on the introductory promo going on, and some charge monthly for you to have this real-time data. And the real-time data is for you to see that asset that you're looking at, whether it's an index or a commodity, see the real-time prices for them and allow you to see the real-time transactions that being bought and sold. So the data is important for you to know where you're getting in a trade, where you're exiting a trade. You don't want your data to be delayed. That is an important piece when signing on to a brokerage. So here we have the clearinghouse is the middle hub that completes transactions from buyers or sellers. They make sure all of the trades and all of the contracts and agreements are met, right? Clearinghouse. And that's for all trading, options, stocks, futures, forex. We have contracts. What is contracts? Okay. So any asset that you're looking to trade, whether it's gold, whether it's the ES 500, whether it's the Nasdaq, whether it's oil, whether it's corn, they have a ticker symbol. Okay. And then they have the contract month codes. Okay. So the contracts are quarterly. So you'll see the month code letter that represents the expiration date of that contract. All right. So we have the contract, the month code that the contract expires, and a 2-digit year. And that is your asset and contract. Okay. Example. We have oil, CL. The Z is for expire in November. The 26 is 2026. Right? The ES, the E mini, S&P 500. The H expires March. The 2-digit is the year, 2026. Okay. All right. So contracts, you can settle when you see profit. You can sell and get your monies. Or you can let it go the whole expiration and settle for physical settlement. Okay. Whereas, like we said, we can trade commodities, corn, oil, wheat, rice, gold, physical assets that you can settle up with getting it delivered to you. Right. Yeah. So you can definitely, the contract specifies what you can do. Right? Most times we want our money. All right. So we will be selling our contracts for profits. Okay. All right. So characteristics of a contract. All right. That's like what we said. The characteristics of a contract. You can settle it before expiration date for physical asset or for cash settlement. You can have it delivered to you. You can roll over the contract if you still want to hold it. You can roll it over to the next month or year. You can do that. So that's some characteristics of a contract. There's a delivery month. There's a tick size that's associated with the contract. We'll get to that on the next few slides. And that's how we get paid. That's how we benefit off of a contract, by the tick size and the movement. The tick size is direct relation to the movement, the price movement of that asset that we are trading. All right. So how we can get started? Obviously, always read the risk disclosures. Trading is substantial risk. You can always practice with a free demo account. Most futures brokerages have demo accounts that you can practice on. Also the live, Tradeovate does. And always when you get an account, you start off small. Start off with small risk, right? Let it build. All right, these are some of the futures brokerages: Interactive Brokers, TD Ameritrade, E-Trade, NinjaTrader, TradeStation, Charles Schwab, Optimus Futures, AMP Futures, Tradeovate. I know NinjaTrader bought Tradeovate, so NinjaTrader and Tradeovate is the same thing. I use Tradeovate. I like Tradeovate. It's a small funding that you need to open an account. I believe it's $100. And the number one reason I like them is because they sync up with TradingView chart platform. And I am always on TradingView chart platform. So for me to be able to execute a trade on the TradingView is absolutely gold for me. So I go with Tradeovate, but you can select whichever is suitable for you. All right, so here is examples of stock index futures contract breakdown. Okay, so we have S&P 500 on the left, and we have Nasdaq 100 on the right. So every futures contract, you can buy a full contract or a fractional contract, smaller position, smaller profits, smaller loss. all right, and that's called the micro. All right, you can buy a full contract, which is the E-mini, and then you can buy a fractional, a smaller size, which is a micro. All right, but every futures contract is saying you are controlling a specific amount of money of that asset in which is the contract size. So you are controlling a contract size, which for S&P 500 E-mini, that is $50 times the S&P 500 index value right now. I believe S&P 500 right now is roughly $6,800. So you would do the math. That is 50 times 6,800, and you are controlling $340,000 worth of S&P 500 by buying one contract of E-mini S&P 500. Okay. Now the tick value, every 25 cent move equals $12.50, whether against you, if the move is going opposite with the way you bought the contract to go, or the way you bought the contract to go, you win $12.50 for every 25 cent move. Okay. Now the micro E-mini, you would be controlling $5 times the value of S&P 500, which 5 times 6,800 is you're controlling $34,000 of S&P 500. Okay. The tick value is how you get paid. Every 25 cent move for micro E-mini goes $1.25 to you or $1.25 against you, depending on the contract you bought to go up or down, and the movement is going the way you bought the contract to go. Okay. So a 10-point move for micro E-mini, 10-point move is $50. All right. So that's how we benefit from our contracts. So for the Nasdaq, the whole contract, the E-mini, you are controlling $20 times the price of Nasdaq. I believe Nasdaq right now is roughly, 25,000 roughly. So $20 times 25,000. So you'll be controlling $500,000 worth of Nasdaq 100, right? And the Nasdaq 100 tick value, every 25 cent move equals $5, right? And now the micro contract is $2 times 25,000 is what you will be controlling, which is $50,000 worth of Nasdaq 100. And that tick value is every 25 cent move equals 50 cents to you. Okay. I will point out that looks low. Every 25 cent move for Nasdaq 100 only look to be 50 cents, and every 25 cent move for S&P 500 equals $1.25 profit. But Nasdaq 100 moves on average between 100 and 300 points a day. S&P 500 moves on average between 30 and 50 points a day. So that's good to know. All right. So that's a breakdown of a contract. What is a contract? What are we doing? So that's what we're controlling, that contract size. It's a value amount. The tick value, how we get paid every 25 cent move equals a certain dollar amount to our account. Okay, that's how it goes. Other assets have different tick values and have different contract sizes. All right, so like crude oil, if the contract size is a flat out 1,000 barrels, the tick value is $10 per 100th of a cent move. Okay, so metals, gold, contract size flat out 100 troy ounces, tick value $10 per every 10 cent move. Okay, you have a micro crude oil. Okay, and that's a contract size 100 barrels. Right, that ticks tick size value is every 100th of a cent move, you get $1. They got a micro gold. Contract size is 10 troy ounces. Every tick value is every 10-cent move is $1. Okay, so that's an overall view of futures, what it is, how we get paid. Okay, next I'll give you a gauge of the chart, how we use our stop losses, how we use our take profit, how we operate buying, selling a contract.